Good afternoon, ladies and gentlemen. My name is TJ Jones, and I will be your moderator today. First, I'd like to thank all of you for taking the time to join us for our first live webinar. The presentation should last about 30 minutes, and we will have time for questions and answers at the end of the presentation. Please use the online tools to type in your questions during the event. Gamble Jones Investment Counsel was started in 1956 by Jim Gamble. We have been in business for almost 65 years and currently manage a little over $1.5 billion. Jim's vision of Gamble Jones has evolved over time to do what we do every day for our clients, and that is working with individuals and families like yourself to give high quality financial advice based on your own unique needs and situations. Our clients are never a number to us, but you are part of our family. Our presentation today will go over our market perspectives and why having a true comprehensive plan is so important. Our presenters today are Michael Erskine, a CFA charter holder. Mike joined Gamble Jones in 2015 and is the current president of our division, Gamble Jones Capital Management, and he leads our research team. Mike will discuss our current market perspectives. The next presenter is Aram Schatz, a certified financial planner. Aram joined Gamble Jones in 2018 and leads our financial planning team. Aram will discuss the importance of having a true comprehensive financial plan. Rob Souza has been with Gamble Jones for over 10 years. He is a CFA charter holder, a senior relationship manager, and a member of our research team. And I have been with Gamble Jones for over 21 years. I am the new business development manager and chief technology officer for Gamble Jones Investment Counsel. Rob and I will help answer any questions you might have during the question and answers part of the webinar. And now I'd like to ask Mike Erskine to start the presentation.
Thank you very much, TJ, for the introduction, and thank you everybody for joining. As TJ had mentioned, I'll provide a high overview of the market, particularly what we saw coming into COVID and the pandemic that we're going through right now, and what we see today. And really focusing on how we're thinking about clients' portfolios and how we construct clients' portfolios today. So to get into it, so really as we entered the end of 2019 and then entered 2020, we started to see a bit of a slowdown in the overall economy. This chart here shows real GDP growth on a year-over-year, on the year-over-year change on a quarterly basis. And really you can see as you got towards the end of 2019, you did start to see a slowdown. In addition, there was a few other areas that started to flash yellow for us. In Q3, capital spending seemed to have peaked and it started to decline in Q4 of 2019. In addition, there was a few other markets that typically are pretty calm markets, started to experience some volatility and experienced volatility to the point where the Fed actually had intervened, particularly in the repo markets. You saw extreme volatility in September, October of 2019. So really, we entered 2020 with a bit of caution. And despite this caution, we did continue to see the market go higher and valuations continue to expand. This chart here shows the forward multiple on the S&P 500. It's essentially the price that investors will pay on next year's earnings at today's prices. And at the end of 2019, it was right at just north of 18 times. And typically when you start to see an economy start to slow down, you would expect valuations to somewhat moderate. And while you look at the end of 2019's valuation metric, it's not egregiously high, particularly when you look at it in context to the dot-com bubble, but it's definitely above average. And as I mentioned, you would expect this to somewhat moderate, not continue to expand higher. And on top of that, we did see some valuation metrics reach all-time highs. So this chart here is commonly referred to as the Warren Buffett indicator. It measures the total value of the stock market relative to GDP, and it actually reached an all-time high as of the end of 2019. And so, very interesting to see it continue to move higher as the market slowed down, as the economy slowed down. And so really, when the pandemic hit, it kind of created a perfect storm. We had January and February of 2020 continue to rise, and it reached an all-time high on February 19th, just shy of 3,400. And we all know what happened when lockdowns started to be discussed. The market took a deep dive, dropped about 34%, ended up being one of the fastest drops in history. And it bottomed on March 23rd. And the bottom really corresponded with Congress and the White House coming to an agreement on a stimulus plan. And since then, the market's gone straight up. As many as you know, the market is forward-looking. It tries to estimate prices in the future and discounts them back to present. Yet, when we look at the market today, we do see a good number of uncertainties. It is something we've talked about in our most recent quarterly letter, but really uncertainties around, when will a vaccine be developed? How soon will it reach everybody, and how effective will it be? What will employment look like 12, 24 months from now? What will the business operations look like 12, 24 months from now? And on a non-pandemic question, how will November's elections impact corporate tax rates and corporate regulations? So typically when you have a large number of uncertainties, you do expect valuations to contract a bit, but we've actually seen the opposite. So again, this is the S&P 500 forward price to earnings multiple, and it has only expanded since the end of 2019. It sits at just north of 22 times next year's earnings. And like I mentioned, you would expect this to continue to somewhat contract given the uncertainty in the market, but it has done just the opposite. An additional area that we've really been focused on, and really focused on the last couple of years, is corporate balance sheets, in particular corporate debt on those balance sheets. And this chart here shows total U.S. corporate debt relative to GDP. It is an all-time high. Now, this chart is as of Q1. If you were to add Q2's data, Q2's GDP number is not out yet. But if you were to include that, it would look even worse. And really, corporations have been almost encouraged to take on more and more debt, given the artificially low rate environment pursued by the Fed or Reserve. So definitely an area we keep in mind, particularly when we're building out the fixed income sleeves of our clients' portfolios. So we do take a step back. There seems to be questions on the growth trajectory of the economy. On top of that, you have corporate balance sheets that seem to be fairly levered. Yet we have a market that continues to go higher. And so I think a lot of investors sit back and scratch their head wondering, well, why is this disconnect between the fundamentals of corporate America and the market? And really the only thing we can point to is Federal Reserve. And so the Federal Reserve has really made it a point of intervening for the last decade or so. And we do feel that market participants have become accustomed to this intervention. Whenever we do have some significant pullback, the Federal Reserve is happily willing to step in, as we most recently saw. So coming into 2020, Federal Reserve's balance sheet sat around $4 trillion. And today it sits around $7 trillion, a $3 trillion increase. Just to give you some perspective, following the 2008-2009 financial crisis, it took a good 5 years for the Federal Reserve's balance sheet to grow about $3 trillion. So really, we've been able to do that just in a matter of months. And it's pretty impressive. In addition, the levels of public debt have continued to rise, and this is really just to fill the void left by the private sector as they've battled some of these lockdowns and try to maintain some operations. And we do believe that this ratio, this public debt to GDP number, to continue to rise. Again, this is as of Q1. As I mentioned, Q2 data is not out yet. But if we were to graph it on there, we do expect it to be even worse. In addition, there's really 3 other reasons why we expect this ratio to continue to climb. One, we do expect the government to roll out more stimulus plans. Congress is currently in talks of doing one or getting one issued by the end of July. And Goldman Sachs has an estimate that they expect at least another $1.5 trillion of stimulus plans by the end of 2020. We think that's definitely reasonable, if not conservative. Additionally, another reason why we feel this ratio can continue to climb, interest expense relative to GDP is at one of the lowest points, and really it makes financing high levels of debt much more palatable. And then third, there's definitely been examples of developed nations running high levels of public debt to GDP for a sustained period of time without blowing up their economy. Japan being a good example of that. Their public debt to GDP ratio is well north of 200%. I think closer to 220% currently. So definitely we think this will continue to rise. And so as we've seen more and more liquidity into the economy, we do feel it has aided asset prices and in particular pushed them higher. And it's aided almost all asset classes as it's trickled out into the economy. And just to gauge the amount of liquidity that we are seeing in the economy, we have this graph here. It's the year-over-year change, the M2 money supply. And the M2 money supply measures cash and near cash, and it captures cash, checking accounts, savings accounts, money market funds, as well as time deposits. And you can really see it's exploded higher in the last few months as our government has pushed more and more stimulus plans. And we do expect this amount of money supply, M2 money supply, to continue to climb higher as the year progresses. So this chart we find very interesting. It's the market performance of 2009 and the market performance of 2020 year to date. And as you can see, 2020 is kind of following the path of 2009 fairly closely, and find that very interesting. Particularly interesting is that both years are somewhat similar. 2009, well, both years suffered from a black swan event, 2009 being the great financial crisis, the near collapse of our financial system, and 2020 being the coronavirus pandemic we're going through right now. And also both years saw significant government intervention to prop them up. And so obviously very well could be a coincidence that 2020 is following 2009. Obviously 2020 could diverge at any point from this path, but it's definitely something we keep in the back of our minds when we're building out clients' portfolios. And just to give some context, 2009 actually saw a positive 27% year for the S&P 500. So take a step back. Uncertainties on the overall economy, valuations seem to be stretched, corporate balance sheets seem to be stretched with high leverage. But on the opposite side of that, you have a Federal Reserve and government that's very willing to step in to prop up and kind of be an invisible hand to the market should it have any pullbacks. So it causes us to be a little more creative when it comes to building out our clients' portfolios today. We want to maintain a good amount of offense and defense. Offense coming from exposure to equities to participate should the government continue to roll out stimulus plans and the market continue to be receptive to those plans. We really want to own common stock of high quality companies. These are companies that have strong balance sheets, companies that have strong competitive advantages, companies that can pass on price increases to their customers. And on the opposite end, we want to maintain a heavy amount of defense, owning maybe a small sleeve of some uncorrelated assets. In some of our non-discretionary accounts, we've started to add gold in the last year or so. In addition, we do want to maintain a good amount of liquidity in both cash and treasuries in a lot of our clients' accounts. We know many of our clients are at or near retirement, and they draw upon their portfolios to fund their lifestyle. So we want to have cash around for that, obviously, and additionally have some cash around as dry powder should some opportunities arise. And then lastly, and this is a risk management tool that we always use, regardless of the environment, but really it's avoiding areas that we feel have troubled fundamentals. Companies with high levels of debt, companies that have used stock repurchase programs to really juice up earnings per share without really growing the operating income of the business, as well on the fixed income side, avoiding non-investment grade debt and or investment grade debt that may become non-investment grade. And really, all strong portfolios sit on top of a strong financial plan, which Aaron will talk about here in a second. But before I pass the baton to him, I do want to quickly mention our 4 Gamble Jones capital management strategies. I know we have many clients on the call that have been with us for many, many years and may not be aware of these strategies. They have been around for 7 years, so they're battle tested. In addition, their performance and results are reviewed by a third party. I'll just give you a quick overview of them. The first 2 on top, our focus and growth strategy, are more performance oriented. They've done really well since inception relative to their benchmarks. In fact, year to date, they've done excellent, outperforming the benchmarks double digit. And the bottom two are equity, income, and balance strategies. These tend to be more income-oriented, capital preservation, and really any one of these strategies we feel would be a good complement to any client's overall portfolio. And so if you have any questions on them, we'd love to talk about them some more. And with that, I'd love to pass the baton to Aram.
All right. So yes, hello everybody. This is Aram Schatz. We may have worked together before. We may have not. We may in the future. But financial planning gives context to how your portfolio should be positioned and various other aspects of your personal and financial life. So let's get into it. We'll first start with the general financial planning process. And there's several steps, but the first step is generally data gathering. We will review your balance sheet or help you create a balance sheet, a cash flow statement, calculate your overall asset allocation. We'll also collect and review various insurance documents, homeowners auto, life insurance, long-term care. We'll look at your estate planning documents. If you don't have any, we'll obviously urge you to look into that. We'll look at your beneficiary designations. We're mainly looking for the relevant data that is core to your foundation, your financial plan, and what is unique to you. The next step is setting some intermediate and long-term objectives. What are your priorities? Maybe right now it's time to reduce debt. Maybe it's time to buy a second house or rental property. Maybe it's college funding time. What are your priorities? Because things need to be put in a specific order of what's more important. We all expect everyone to live longer, so retirement planning is very important. But it may not be as important right now as maybe getting your child or grandchild through college, or financing that first home. So it all depends on your unique situation. Step 3 is mainly if there's action to be taken, we can discover what needs to be taken. All plans, you have a plan whether you realize it or not. Estate planning is a great example because in California, you don't have any estate planning documents, you don't have any beneficiaries. The state of California has a estate plan for you, which is called probate. A not very fun, quick, or inexpensive process to go through where the courts decide who will receive your assets. That's an example of everyone having some type of plan in place, whether they like it or not. So step 3 is understanding if no action is taken or no new direction is taken, how will things play out, and what steps can we make now to achieve the outcomes we're looking to achieve that we've defined in step 2. Step 4, with all this data in mind, we'll come up with recommendations, and usually during the discovery process, some of the recommendations become obvious, and you may have new ideas that you can implement on your side, or may have new information to share with us that will help us guide you in the right direction. But this is obviously only after the discovery process is finished, and again, helping you understand if you need to stay the course that you're on or make immediate or potentially long-term changes. Step 5, presenting the recommendations. Sometimes they'll be topical. If we have one-off discussions, they'll be topical on one area of the plan, or in general, we'll give you a long-winded letter of what you need or what we think you need to do and what steps you need to take. And then implementing the recommendations. As you know, we're at its core, Gamble Jones is a portfolio management firm, and we can implement growing your assets. We can help you identify areas to save on taxes, but we're not CPAs. We can help you, we can review your estate tax documents, point you in the right direction in that area, work with your estate planning attorney where necessary. We can review your risk management and insurance documents and point you in the right direction of who you may need to talk to in that area. But at our core, we will help you implement the investment ideas and work with you and your other professionals on the other topics. So use this as a resource in that area if you're not sure which direction to go. Monitoring, always need to, the planning process requires updating when your personal or financial situation changes or the laws change. I mean, the last few years we've had the CARES Act, the Secure Act. They have significant changes. They have implications in the short term and the long term. How do those affect your long-term planning or the planning that has been done or that you expect to do? So we obviously need to monitor your progress and update it where necessary. And the last step is, when necessary, you start the process again. Are you starting a family? Are you getting married? Are you getting divorced? Is retirement 5 years away? Is it 2 years away? Is there an early retirement coming up? What's going on and how does that affect what you need to do next, if anything? So there's several core areas of financial planning that we'll discuss now. Investment planning, as you know, that's Gamble Jones's bread and butter, and we implement with individual securities. On the risk management side, again, that's insurance. We'll again talk about long-term care, potentially life insurance, your homeowner's policy, your auto policies. Right now with auto policies, if people aren't driving, you need to make sure your insurance companies realize that and not charging you for the 20,000 miles they think you're going to drive because you're only driving 5 now. So little things like that can be very helpful. On the tax planning side, we'll definitely need to look at your tax return and potentially uncover opportunities for mitigating taxes now or in the future. And that's typically the only choices you have: pay them now, pay them later. And that can be a big discussion. Estate planning, again, we'll look at your estate planning documents and beneficiary designations. And that's the start of the review. Maybe some changes need to be made. Maybe over time, the people that you've named beneficiaries or whatnot may need to be updated or added, grandchildren, for example. On the retirement planning side, retirement is all about cash flow. So what we like to do is help you project your retirement income needs and ensure you're utilizing the employee benefits you may have and the various retirement account options you have, whether that's a 401k plan at your employer, deferred comp plan, maybe some Roth accounts, Roth IRA, Roth 401k. What are your options and what are the best ones to use in your current situation? Additional planning areas: higher education planning, college education. The main tool there is 529 savings plans. We can help you set them up. We can help you get them funded systematically so you can grow assets for your kids or your grandkids. College education expenses are not going down. They're only going up. There's over $1.6 trillion in student debt right now. So getting funding in that area and using a tax efficient vehicle like a 529 plan is very helpful. Gift and philanthropic endeavors. We would review your current charitable giving strategy or help you create one. It all depends on your resources, whether you have high income, whether you have high assets, what do you have, and how can we best use those to satisfy your charitable giving and also reap potentially some tax benefits from it. And then the legacy generational wealth transfer. We'd like to guide you through the options you have for passing wealth on to the next generation in a manner that is appropriate for your situation and your benefactors. Do you want them getting everything outright? Do you want a stream of income going to them? It depends on family dynamics, and there's a lot to be said there, but that is a step we like to talk about towards the end of the planning process. And then before I go to the next slide, I just want you guys to treat us as a resource. One, if you haven't started the process and you'd like to start the financial planning process, please contact TJ, please contact me, and treat us as a resource. If a new law comes out or your situation changes, maybe a whole plan doesn't make sense or it doesn't make sense to go through the whole process again immediately, but maybe that one area we can give you our 2 cents on and help you make the right decision. So with that, I'll turn it over to TJ.
Thank you very much, Aram and Mike. I really appreciate that. Now on to the question and answer portion of the webinar. Please feel free to ask all questions, any questions that you might have using the online tool, and to type in your question, and we will answer them as we see them come in. While we are waiting for these for the questions to be gathered, I'd like to go over some of the additional services Gamble Jones offers that you might not know about. Some of the key things is that at Gamble Jones, we work as a team. The entire office is there to help support you. But when you call in, you have a dedicated senior relationship manager that is there to answer all your questions. But at some points, the individuals are out of the office, and the rest of the team is there to help support you, our client. The other portions of this are things that you probably already know, such as being able to do portfolio reviews with your relationship manager as needed. And as Aaron just talked about, really going over and doing a comprehensive financial plan, and then doing an annual review with that plan to see if there's any updates. These are very important parts of the financial health for our clients and individuals, especially in today's environment. A lot of the other items that we do, which Aaron has also talked about, which is doing estate plan reviews. We also have our full service client service team. Our client service team is there to make sure that you, our client, have all the items checked off that are needed for check request, money movement, opening a new account, funding children's accounts, maybe gifting assets, things of that sort. Our client service team is there to help support that, and so forth, where we are able to not only work with your current attorneys or CPAs or your professionals, but if you don't have a professional and that you need to work with someone, we will be there. We have a lot of professionals that we feel certain are qualified to work with our clients and give that white glove type service that our clients have come to expect from Gamble Jones. So with that, I'd like to kind of turn this over to our question and answers. Some of these questions are coming in. I'll ask some of these questions as they see fit. I'm going to ask my team to answer who feels is probably best suited to answer this question. The first question that I have is, do you expect more market volatility as a result of the presidential elections? So I'll turn that over to Rob and Mike to maybe answer this one.
Yeah, we can start off and sure. So market tends to be, as I mentioned, forward-looking. So what volatility we do expect probably will come more September, October, as the market tries to price in who will be the president. And then also, obviously, I'll trickle into whatever respective industries that may be affected by whatever administration. I think post-election, if we're going to see any volatility, it's probably going to come more if plans are introduced by a new administration or by the current administration that are not what the market expected. But I expect if we do see volatility, it's going to be more September, October as the market tries to price it in. I don't know, if Rob, if you have anything to add to that.
Yeah, so this is Rob. Good afternoon, everyone. No, I wouldn't add too much to that, Mike. I'd say really just kind of depends as we get more clarity around Biden's tax plan. We also have to keep in mind Federal Reserve policy and liquidity, which has been a big driver of the market. So I think that's kind of agnostic to who you see as president. So we'll see how that kind of continues. And I'm sure that'll play a big role as well. But as the market tries to figure out, where we go with coronavirus and the post-coronavirus economy, we're likely to continue to see volatility. Although, that's kind of left for now, I'm assuming it will come back.
Perfect. Thank you very much for the answer on that one. I have another question here. This one, and it could probably have just been answered, but I'll ask it anyway to see if we need to add to this. Will the national debt affect Gamble Jones's future strategy of investing? Additionally, tensions seem to be running higher and higher with China with Houston consulate.
Yeah, no, it's a good question, and we'll try to tackle it. I mean, we do try to focus on some of the macro, as we mentioned, and really keeping some defensive positions, gold in particular for many of our discretionary accounts, as well as cash. And we do believe that would provide a bit of a buffer should there be fallout from China, some of the stuff that's going on in China, or other macroeconomic events that could occur. And with the extra cash, we do like to have it around as dry powder. We realize Maybe we missed out on a little bit of excess return by having some dry powder, but we think long term it's beneficial to compounding over a long period of time.
Yeah, no, I think when you look at the economy, with the increasing debt, I think if you look at Japan as an example, with high levels of public debt to GDP, what you see is a crowding out effect from the public sector impacting the private sector. And so from that standpoint, you're likely to see more muted growth. And so I think it's really important to focus on long-term secular growth themes within the equities you own, but also paying a reasonable price for those companies. And the other point that I'd like to make too is, looking maybe second derivative, down the road, what's likely policy. It's probably unlikely that we outgrow our way out of this debt. And so I think continued stimulus and easing by the Federal Reserve's a likely outcome. And what would benefit from that? And in general, we think what would do well is, again, companies with pricing power, as well as real assets like gold, potentially real estate, things like that, which could do well if we see inflation down the road. Right now, we're still in an environment that's probably more deflationary than it is inflationary, given the amount of debt in the system. But to the extent stimulus keeps on coming in hot, inflation's a potential theme that we were focused on down the road. And so from that standpoint, that's why we've been a net buyer of gold over the last year.
Thank you very much for that. We have another question here. There is a huge amount of money being poured into the technologies associated with the vaccine development. Biden has also committed to increasing the government investment in R&D. Do you see these investments as swaying your strategies?
Good question. By and large, when we do look at companies looking bottom up, and where we do feel there could be a large influx from the government and spending, we do try to take advantage of that. For example, we know we have some companies that may benefit from increased infrastructure spend, and we've made bets in that direction. I think more on the point of pouring money into finding a vaccine will help overall economy. Obviously, it'll help the individual companies that create a vaccine, but I think a lot of that's probably already priced into the market for those particular companies. Vaccine will probably benefit more the overall economy. And in terms of like R&D spend, what the government is putting in, obviously it'll impact certain sectors, and we do hope to, if a company is trading at a reasonable price and we know that's a tailwind, we'll definitely look in that direction. I don't know if Rob, you want to add anything to that?
Yeah, I would just say, a vaccine would obviously cause us to get incrementally bullish on the economy and potential growth prospects. Remember, there's huge swaths of the economy right now shut down still. And so to the extent that those can open back up, that's a net positive for growth, and that might cause us to kind of revisit some of our assumptions. Because right now we're kind of in a stagnation phase where, it's a slow reopening. We're seeing some rebound, but it's really uncertain as to when things get back to normal. And as far as individual stocks, our expertise really isn't on the science side. What I would say is, whoever does develop the vaccine will obviously get a big one-time boost and should be really a net positive for that company. But, really our focus is on looking at durable earnings streams, secular trends that are going to last well into the future, and, really putting our research behind that.
Perfect. Thank you. I do have a quick question here. Looking forward, which sectors of the market do you think will do best?
I think overall we've definitely had a theme towards tech. We do think, particularly for the last few years, the market has underestimated the move towards tech, and we do think it will continue to move higher. Particularly in today's low interest rate environment, I think tech does better than your traditional old value type names. So I think overall tech will continue to do well. Healthcare is kind of up in the air depending on what the new administration looks like and what Congress looks like. But again, we do have exposure to healthcare, but our strong point is not figuring out the science on all of it. But yeah, overall I feel tech is probably the most important sector that we tend to focus on as well.
Yeah, I would just add to that, we try to stay diversified across all sectors. I mean, obviously consumer staples and some of the necessities, those are areas I think they're interesting in a low interest rate environment with, higher dividend yields, people searching for income. So to the extent you can pay reasonable prices for those companies, they have pretty predictable revenue streams. And so those are interesting areas as well. I'd say the areas, maybe looking at it from the flip side, that we've tended to stay away from is, in general, oil, right? I mean, that's a commodity market, heavily influenced, by geopolitical factors. Obviously, demand's way down right now with increased supply, which has caused a glut in that market. And so we've just tended to stay away from that. There's really no pricing power. Those are price-taking companies. And then if you look at financials, we think the general theme for the big money center banks and financials is continued pressure, especially if rates stay low. I think you have a real line of sight into that looking at the European banks and the Japanese banks, which have struggled for a long time, given the policies run there by their central banks of zero or negative interest rates. So, it's going to be, I think, a tough slog forward for those companies. Their balance sheets are good, so we feel like they're fine from a capitalization perspective, but from an earnings perspective and an equity perspective, we're not really that bullish there.
Perfect. I'm going to pivot one. We got one for Aram here. Aram, do you think today is a good time to refinance your mortgage?
Yeah, it certainly could be. Depends on how much principal is left and the purpose of it. Some people might want to refinance just to lower their cash flow needs. Well, boost their free cash flow, but knowing that they'll probably pay more interest over the long term if they renew it to 15 or 30 year, whatever it is. Some people just looking to lower their payment makes sense. And if they even wanted to pay their mortgage off sooner or on the same schedule that they originally had before they refinance maybe the first or second time, they could always apply that extra savings and interest costs to the principal of the mortgage and maybe pay it off sooner. So it's definitely something to look at. Rates have fallen dramatically. They made it a little more difficult to refinance. But it's worth, I think it's worth, as long as the numbers make sense, it's worth jumping through the hoops. So just make sure you check the numbers first. We can do that for you if you need help on that regard.
Thank you, Aram. I've got a good one here. What happens if stimulus to the public stops and public spending commensurate with current stimulus supporting unemployment stops driving corporate profits?
Yeah, no, I think that's a big question everybody's messing with today. Is this does seem a bit of a disconnect between the fundamentals and the market, and the market has been very receptive to whatever stimulus the government's put out there. And if the market stops being receptive to it, definitely watch out. And we hope to take advantage of that. And I think if the market does stop being receptive, we will have a strong pullback in the market, and it'll be interesting to see what happens from there. But really, it's kind of anybody's guess on what truly happens. But I don't think it'd be pretty, and we hope to take advantage of it should it happen. Rob, you want to add anything to that?
Yeah, no, I think you said it well, Mike. I mean, from our standpoint, corporate profits have been flat really for the last couple of years. So, what you're seeing right now is just a real increase in the multiple investors are willing to pay for those earnings. And that's obviously driven, like we've mentioned, by central bank support. It's also driven by the amount of liquidity that you're seeing flowing in and the fact that rates are low, which generally in a low rate environment, you would expect higher valuations, as people crowd into stocks. So, we think that that continues. And, again, as liquidity flows out, if you see liquidity taken out, we would expect to pull back, hence some of the defense in our portfolios to be ready if that does occur. But I would expect central bank to be on this to the extent they can.
Perfect. Thank you, you guys. I have another one for Aram. Aram, if I'm already retired, is financial planning worthwhile?
I believe so. Absolutely. I mean, at the very least, to review certain aspects. Maybe your estate planning documents were drafted 30 years ago. Maybe you haven't looked at your beneficiaries. maybe you want your portfolio to be X dollars in 20 years. Well, can we get it there, and what do you need to spend? So it doesn't hurt to go through the review process, and say you're in your 75. We would look at different things immediately and make sure we cover everything, but there's certainly a different priority list when it comes to people that have been retired or people that maybe been retired a few years. So yes, I definitely think it's worthwhile, at the very least, to check it off the list.
Perfect. Thank you, Aaron. It looks like we have maybe 2 more questions that we have time for today. So let's go with what adjustments to portfolios will you make if a Biden/Warren win in November?
Yeah, that's a good question. And really, when we build out clients' portfolios, when we pick individual stocks, we are looking long term. We're looking 7-10 years out, what we think those companies will be doing and what strong secular trends will be happening. So these secular trends should outlive any administration. But with that said, we do take that into consideration, and maybe we'll limit position sizes of certain companies that may be targeted by a certain administration. For example, in many of our clients' accounts, we hold Google and or Facebook. I think those companies do face more pushback in say a Warren or Biden administration. So we still like the long-term secular trends that those companies have and the tailwinds that those companies have. But we would also be cognizant of some of the regulatory risk that's out there, and would maybe limit position sizes somewhat. In addition, I think the banking sector probably, again, we're not super bullish on the banking sector, but we do think it'd probably be affected, particularly if you see a Warren. I think there's some talks of the Secretary of the Treasury if Biden was elected. So something we would definitely, reducing our positioning sizes as well in those particular areas. I don't know if Rob, if you'd like to add anything on top of that.
Yeah, I think, just the big tech, obviously, they've been a target, at least, on the surface from a regulatory standpoint. There's been some sniffing around in those areas. So that could continue. And if that does, that might cause us to reevaluate position sizes just for risk management purposes. Healthcare is obviously a wild card. You have to see how that plays out and what their policies look like. So I think there's still a lot that's really unknown at this point. I don't think it would change our general strategy. We try not to let the politics, play too much into that. Obviously, we'll make changes around the fringes as we see things or opportunities that present themselves.
And one other thing I'd like to add to that as well is, when we do look at companies and we are assessing the risks, we do try to avoid companies that may their overall growth may be affected just by the swipe of a pen in Washington. So we are very cognizant of whenever we do invest in a company, if it's receiving a massive tailwind from some law or regulation that gives them somewhat pricing power, we do consider that as well when adding or positioning size as well in portfolios.
Thank you, guys. And this will be our last question. And for anyone out there that still has any questions that maybe didn't get answered, I definitely want you to know that you can give us a call or send us an email. So the last question that we have here for today for the webinar is, do you think uncertainty about overseas supply chains will cause a shift in manufacturing back to the U.S.?
Definitely, and I think a lot of companies right now, they're looking at China, and I think it's becoming more and more prevalent around the globe, where you see India is having border issues with China. It seems like the EU is also questioning some of the relations with China. I do think we were going from a period of really peak globalization that we've had and enjoyed for the last 10, 20 years. To less globalization, and as companies are going to shift some of their supply chain and supply chain lines out of China. I think for some companies it's going to be, and it's something we consider are going to be more difficult. Apple being a prime example. I mean, they depend heavily on China for a lot of the manufacturing. So I think it's going to be harder to unwind some of that for them. But we do expect more manufacturing and more supply chain to come out here. Probably company supply chains becoming less efficient, which would then put pressure on profit margins somewhat. And in addition, it may even lead to some inflation a few years down the road. We'll see, particularly if the government decides to provide subsidies to get companies out of China and some other troubled nations. But yes, we definitely are keeping a close eye on that. And Rob?
I think the other thing to note, and maybe a higher level picture, is, and where this gets at, is how financialized our economy got, in terms of companies really maybe skimping on R&D spending, cutting costs, outsourcing, all in the quest for juicing profit margins and increasing stock prices. And so I think, that's something we've noticed for the last couple of years, and it's really driven our strategy towards a lot of companies that really are investing in their businesses and are generating long-term secular growth, right? And so I think what you're seeing now is, that's coming back to haunt the companies that tried to play the game, and you're going to move to a more productive economy, hopefully, where companies are spending, on CapEx, R&D, looking to create things, which hasn't really happened in the past, right? Despite the increase in the stock market, over the last 20 years, CapEx is actually down. So we've seen less net investment. It's more financial engineering. And, that's really been driven, as Mike mentioned in his presentation, by increased debt levels and low interest rates. But I think that game's kind of played out. And, that causes us to be really cautious on companies that try to use that as their means of boosting stock price. We'd rather let the company invest in itself. A name that we own for a number of clients, Amazon, is a prime example of that. It's a company that continues to invest heavily in new opportunities, CapEx, and those are the type of companies we want to look for. They're driving growth and have secular tailwinds headed forward.
Thank you very much, Rob, Mike, and Aram, for your time today. I want to also thank all of you that are on this webinar today for taking the time. This concludes our presentation today. Thank you for being part of the Gamble Jones family. If any of your family, friends, or neighbors could use our help, we would love to meet them. Have a great rest of your day and week. Stay healthy and safe. As always, we're here to answer any questions you might have, so please call or email.